Hedging and diversification both aim to cut unwanted volatility, but they do it in different ways and fit different situations. Hedging is a targeted, often short-term fix. If you own something that would lose value in a specific scenario, you take an opposite position that would gain in that scenario. Common tools are options, futures, forwards, and swaps. Examples: buying puts to protect a stock before an earnings release, locking in a currency rate with a forward before a big foreign payment, or selling commodity futures to guard against a price drop. The upside is you can reduce or eliminate a defined risk and tailor the size and duration of the protection. The downsides are cost, premiums, spreads, margin, imperfect coverage, basis risk, and the chance you give up upside if the market moves in your favor. Diversification is broader and longer term. You spread money across assets that don't move together, so losses in some holdings are offset by gains in others. Think stocks and bonds, different sectors and geographies, real assets, and alternatives. It's low cost, simple, and effective at removing idiosyncratic risk without constant trading. But diversification won't fully protect you in a market-wide crisis, can dilute returns if overdone, and depends on correlations that can change under stress. When to use each. Hedge, when you face a specific quantifiable short-term risk or a concentrated exposure you can't tolerate, big single-stock bets, known foreign receipts. Use diversification as the foundation for a long-term portfolio to manage everyday volatility and avoid single-point failures. Practical tips. Start by defining your risk tolerance and time horizon. Size hedges to match the risk, not necessarily the full position, and keep an eye on cost versus benefit. For diversification, focus on low correlations and complementary return drivers. Rebalance regularly and be aware correlations can spike in crises. Track outcomes with measures like portfolio volatility, VR, beta, and the Sharpe ratio. Neither tool removes all risk. Hedging can be pricey and imperfect. Diversification can break down in systemic shocks. The sensible approach is to diversify broadly and use hedges selectively for high-consequence specific risks.